This week we're going to talk about accrual accounting versus cash accounting and income. So accrual accounting records the impact of a business transaction as it occurs. When the business performs a service, makes a sale, or incurs an expense, the accountant records the transaction even if the business receives or pays no cash. So we can see the difference there is that when as a company, if I make a sale and the customer may pay me in cash, they may not pay me in cash, they may make a promise to pay me later, which is an accounts receivable for me and it's an accounts payable for them. So under either of those scenarios, I'm able to recognize the revenue associated with that sale. So Chapter 3 will focus on accrual accounting and income. So as we said earlier, we'll talk a little bit now about how accrual accounting differs from cash basis accounting. So managers want to earn a profit, obviously. That's what they get paid for. Investors search for companies whose stock prices will increase. Banks seek borrowers who will pay their debt. Accounting provides the information these people use for decision making. Accounting can be based on either the accrual basis or the cash basis. When accrual accounting records the impact of a transaction as it occurs. When the business performs a service, makes a sale, or incurs an expense, the accountant records the transaction even if the business receives or pays no cash. Cash basis accounting records only cash transactions, cash receipts, and cash payments. Cash receipts are treated as revenues and cash payments are handled as expenses. Generally accepted accounting principles, or GAAP, as you recall from our earlier discussions, require accrual accounting. So you must use accrual accounting if you are going to report your financial statements in accordance with GAAP. And this sometimes for companies who record cash basis means that in order to get an audit opinion that says they're in compliance with GAAP, that they have to restate their financial statements. So the basic defect of cash basis accounting is that the cash basis ignores certain information that makes the financial statements incomplete. Companies that use the cash basis of accounting do not follow GAAP. Their financial statements omit important information. All but the smallest businesses use the accrual basis of accounting. Accrual accounting is more complex and more complete than cash basis accounting. Accrual accounting records cash transactions such as collecting cash from customers, receiving cash from interest payments, paying salaries, rent, and other expenses in cash, borrowing money, paying off loans, and issuing stock. But accrual accounting also records non-cash transactions such as sales on account. So sales that we generate an accounts receivable from the client on that they're going to pay us later. Purchases of inventory on account. So we buy inventory and take possession of it, but we don't pay cash for it today. We promise the vendor we'll pay them 30 or 45 days or however long our terms and conditions are for our agreement down the road. Accrual of expenses incurred but not yet paid. Depreciation expense. Usage of prepaid rent, insurance, and supplies. And you recall we talked about prepaid accounts earlier. And then earning of revenue when cash was collected in advance. So these are some of the differences between transactions that when they're recorded on a cash basis versus a non-cash basis. We just want to keep in mind that accrual accounting records both cash and non-cash transactions. And we also want to keep in mind also that cash basis accounting is not GAAP. The only way for a business to know for certain how well it performed is to shut down, sell the assets, pay the liabilities, and return any leftover cash to the owners. This process, called liquidation, means going out of business. Obviously, ongoing companies can't wait until they go out of business to measure income. Instead, they need a regular progress report. Accountants, therefore, prepare financial statements for specific periods. The time period concept ensures that accounting information is reported at regular intervals. The basic accounting period is 1 year, and virtually all businesses prepare annual financial statements. Around 60% of large companies use the calendar year from January 1 to December 31st. A fiscal year ends on a date other than January 1. Most retailers use a fiscal year that ends on January 31st because the low point in their business activity falls after Christmas. Companies also prepare financial statements for interim periods of less than a year, such as a month, or quarterly, or semi-annually. So the second thing we want to talk about tonight is how to apply revenue and expense recognition principle. The revenue principle deals with two issues: when to record revenue, that is, make a journal entry to record revenue, and the amount of revenue to record. When should you record revenue? After it has been earned and not before. In most cases, revenue is earned when the business has delivered a good or a service to a customer. It's done everything required to earn the revenue by transferring the good or service to customer. The amount of revenue to record is the cash value of the goods or services transferred to the customer. Now keep in mind we said it's the cash value transferred to the customer. It's not necessarily tied to, the recognition of revenue is not necessarily tied to the receipt of cash from the customer. So the other side of the equation, the expense recognition principle, is the basis for recording expenses. Expenses are the cost of assets used up and of liabilities created in the earning of revenue. Expenses have no future benefit to the company. The revenue recognition principle, also known as the matching principle, includes two steps. Identify all expenses incurred during the accounting period, measure the expenses, and recognize them in the same period in which any related revenues are earned. To recognize expenses along with related revenues means to subtract expenses from revenues to compute net income or net loss. And this matching principle concept is one of the core foundational concepts in accounting, and it is essentially saying that I match my revenue and my expenses. And if my expenses didn't generate any revenue, well, when the transaction that generated the expense is over, the expense should be recognized, and if there's no offsetting revenue, it simply flows to the bottom line and decreases my net income or creates a net loss for me. But I would wrap my hands around and read it several times if you need to, this matching principle, because it's core, again, to the accounting function. So then next we want to talk about how we adjust the accounts. So financial statements are issued at the end of the period. The process begins with the trial balance that we talked about in Chapter 2. We refer to this trial balance as unadjusted because the accounts are not yet ready for the financial statements. In most cases, the simple label trial balance means unadjusted. The stockholders need to know how well the corporation they've invested in is performing. The financial statements report this information, and all accounts must be up to date. That means some accounts must be adjusted. Accounts such as cash, equipment, common stock, and dividends are up to date and need no adjustments. That's because the day-to-day transaction provide all the data for these accounts. Accounts such as accounts receivable, accounts payable, supplies, prepaid rent, and other accounts are a different story. These accounts are not often up to date at the end of the year. Why? It's because certain transactions have not yet been recorded. Accounting adjustments fall into three basic categories: deferrals, depreciation, and accruals. A deferral is an adjustment for an item in which the business paid or received cash in advance. Companies purchase supplies for use in their operations. During the period, some supplies or assets are used up and become expenses. At the end of the period, an adjustment is needed to decrease the supplies account for the supplies used up. This is supplies expense. Prepaid rent, prepaid insurance, and other prepaid expenses require deferral adjustments. These are also deferral adjustments for liabilities. Companies may collect cash from a customer in advance of earning the revenue, so perhaps the customer prepays the company. When a company receives cash up front, it has a liability to provide goods or services for the customer. This liability is called unearned sales revenue. Then when the company delivers the goods to the customer, it earns sales revenue. This earning process requires an adjustment at the end of the period. The adjustment decreases the liability and increases the revenue for the revenue earned. Depreciation allocates the cost of a plant asset to expense over the asset's useful life. Depreciation is the most common long-term deferral. Many businesses own buildings and equipment. As a company uses the asset, it records depreciation for wear and tear and obsolescence. The accounting adjustment records depreciation expense and decreases the asset's book value over its life. The process is identical to a deferral type adjustment. The only difference is the type of asset involved. Plant assets are long-lived tangible assets such as buildings, land, furniture, and equipment, all plant assets but land decline in usefulness, and this decline is an expense. So we want to always remember that land does not depreciate. Accountants spread the cost of each plant asset except land over its useful life. An accrual is the opposite of a deferral. For an accrued expense, a company records the expense before paying cash. For an accrued revenue, the company records the revenue before collecting cash. Salary expense, for example, can create an accrual adjustment when employees have worked but won't be paid for that work until after the current accounting period. Other examples of expense accruals include interest expense and income tax expense. An accrued revenue is a revenue that the business has earned and will collect next year. The adjustment debits a receivable and credits a revenue. For example, accrual of interest revenue debits interest receivable and credits interest revenue. Prepaid expense is an expense paid in advance. Therefore, prepaid expenses are assets because they provide a future benefit for the owner. Over time, these benefits expire or are used. Examples include prepaid rent and supplies. When these items are purchased, an asset is recorded. The adjustment records an expense for the used portion and decreased the asset. So, for example, let's say a company paid for 3 months' rent in advance, $1,000 a month. Then on June 2nd, it purchased $700 of supplies. At that time of these purchases, assets were recorded. So when we paid the rent $1,000 per month, we paid it up for 3 months ahead. We debited prepaid rent because it's an asset, a prepaid account, and we credited cash. When we bought the supplies, we debited the supplies account, an asset account, and credited cash because we spent cash. Over time, the benefits of a prepaid expense expire and the assets are used. The adjustment records an expense for the used portion and decreases the asset. So at June 30th, 1 month of the rent has expired. So our prepaid amount is no longer $3,000, it's $2,000. So we have to adjust $1,000 out of the prepaid rent account, which reduces that asset account. And so, as we said earlier, we reduce asset accounts with credits, and we're debiting a rent expense because we used up $1,000 of that rent over the 1 month that we maintained occupancy of the premises. For the supplies, only $400 of supplies were on hand at the end of the month. So that means $300 of supplies were used. We started with $700. We have $400 left at the end of the month. That means we used $300. So our inventory of supplies went down. Supplies is an asset account, so we credited the supplies asset account, and we debited the supplies expense account, which is an income statement account. The T accounts for prepaid rent and rent expense show how the purchase and adjustment of the accounts impact the financial statements. And we can see the prepaid rent account is a balance sheet account, and after we used up $1,000 of that, we have $2,000 left, which will be reflected as an asset on the balance sheet account. And we see that we used that $1,000 is going to be reflected as an expense on the income statement account. The T accounts for supplies and supplies expense show how the purchase and adjustment of the accounts impact the financial statements. And so it's the same scenario. We started off on June 2nd with a debit in our supplies asset account of $700. We ended up with $300 left in the account at the end of the month. So that means we expensed for $300 worth of supplies, and that is what's reflected on the income statement. Depreciation. Plant assets are long-lived, tangible assets, such as land, buildings, furniture, and equipment. All plant assets except land decline in usefulness, and this decline is an expense. Depreciation is the process of allocating cost to expense for a long-term plant asset. So to illustrate depreciation, let's just say a company purchased equipment on account on June 3rd for $24,000. The company records an asset when it purchases equipment. Then, as the asset is used, a portion of the asset's cost is transferred to depreciation expense. The machine is being used to produce revenue. The cost of the machine should be allocated or matched according to our matching principle against that revenue. There's another illustration. This is another illustration of the expense recognition principle. The equipment will remain useful for 5 years and then will be worthless. One way to compute the amount of depreciation for each year is to divide the cost of the asset, $24,000 in our example, by its expected useful life of 5 years. For our example, this equals $4,800. Since we're adjusting for 1 month, we divide this amount by 12 for a monthly depreciation of $400. Now we can see here the debit and credit entries that are associated with the purchase of the equipment and then the depreciation of the equipment. Here we can see the T accounts for equipment, accumulated depreciation, and depreciation expense, and we see the impact of these journal entries. We do note too that the equipment account is not affected by the adjusting entry recording depreciation. Accumulated depreciation is an account that shows the sum of all the depreciation expense from using the asset. Therefore, the balance in the accumulated depreciation account increases over the asset's life. Accumulated depreciation is a contra asset account, an asset account with a normal credit balance. You recall earlier we talked about that assets have normally have debit balances. Well, because this one has this account, accumulated depreciation, normally carries a credit balance, or should always carry a credit balance. We call it a contra asset because it's contra, the balance is contra to what all of the other asset account balances would normally be, that being a debit. So a contra account has 2 distinguishing characteristics. It always has a companion account. So accumulated depreciation's companion account is equipment. And then its normal balance is opposite that of the companion account. So the net amount of a plant asset, which is cost minus accumulation depreciation, is called that asset's book value or carrying amount. On the balance sheet, plant assets are shown at their book value, the cost of the asset minus the accumulated depreciation. And sometimes on a balance sheet, you won't see equipment less accumulated depreciation and book value. You'll just see net plant, property, and equipment. So it might just be presented as one number. But inherent, the understanding is inherent to that number is a listing of equipment accounts or asset accounts offset by a listing of accumulated depreciation accounts. Businesses may incur expenses before they pay cash. Consider an employee's salary. A company's expense and payable grow as the employee works, so the liability is said to accrue. So if I wanted to be very detailed about it, every day I had an employee come in and work. At the end of that day, I could accrue or record how much I owe that employee for that day's work. And so that account balance just continues to grow each day until their payday when I relieve that account. So the term accrued expense refers to a liability that arises from an expense that has not yet been paid. Companies don't record accrued expenses daily or weekly, obviously. Instead, they wait until the end of the period and use an adjusting entry to update each expense and related liability for the financial statements. And so this is another example of an accrued expense, and it's accrued salaries. Most companies pay their employees at set times. Suppose a company pays its employees a monthly salary of $1,800, half on the 15th and half on the last day of the month. During June, the company paid its employees the first half month salary of $900 and made the first entry on this slide. Because June 30th, the second payday of the month, falls on a Sunday, the second half month amount of $900 will be paid on Monday, July 1st. At June 30th, therefore, the company adjusts for additional salary expense and salary payable of $900. And so the scenario is, again, on June 15th, the company paid the first 2 weeks, so they debit salary expense and they credit cash, because salary expense is an income statement account and it should be matched against the revenue that was generated as a result of that work. And expense is a asset account and it's decreasing, and so it's decreased by a credit. And then we hear that, well, on July 1st, which is a day after the company closes its books for the month of June, on July 1st, the company pays its employees But that means then on June 30th, the company owes the employees $900 or the employee $900, and so we still record the expense because they worked the effort during the 15th or the 16th of June through the 30th, but because we aren't paying it, we accrue it, and the expense is reflected in the salary payable account. After posting, the salary payable and salary expense accounts appear as follows. The accounts now hold all of the June salary information. Salary expense has a full month salary, and salary payable shows the amount owed at June 30th. All accrued expenses are recorded this way. Debit the expense and credit the liability. Businesses often earn revenue before they receive the cash. Revenue that has been earned but not collected is called an accrued revenue. All accrued revenues are accounted for similarly. Debit a receivable and credit a revenue. Let's say a company is hired on June 15th to clean equipment for $600 per month, receiving the first payment on July 15th. As of June 30th, half of the fee will be earned. The entry to record the revenue that has been earned is shown above. So you can see that we are recording just the first half of the month's revenue that we earned from June 15th to June 30th, and that's $300. So we're recording the $300 revenue, even though we haven't been paid it. Accrual accounting says we recognize it when we earn it, so we earn the $300, and then it's owed to us, so it's an accounts receivable, which is an asset account, so it's owed to us by a client, so we debit our asset accounts for $300 and we credit our service revenue, which is an income statement. Some businesses collect cash from customers before earning the revenue, that is, the client or the customer prepays. This creates a liability called unearned revenue because we've received the cash, but we haven't earned the revenue. We haven't delivered the product or performed the service. This action creates this unearned revenue. Only when a job is completed does the business earn the revenue. Suppose a real estate management company engages a company to clean its office building, agreeing to pay the company $400 monthly, beginning immediately. If the cleaning company collects the first amount on June 15th, then it records this transaction in this slide. So they received $400 on June 15th, but they won't finish their work. They won't be completed with the job until June 30th. So we debit cash because we're receiving cash, but we credit unearned revenue. And then once we've completed the work, once we have no more obligation to perform, to provide service, or to provide product, we can debit unearned revenue and credit earned revenue. Unearned service revenue is a liability because the company is obligated to perform services for the real estate management firm. During the last 15 days of the month, the company will earn one half of the $400 or $200. On June 30th, the company makes the adjustment shown above. This adjusting entry shifts $200 of the total amount received from liability to revenue. So you can see again, at the end of the month, we earned half of the $400 that we were paid. So we're just simply reclassing it by debiting the liability account unearned revenue because we're decreasing that, and we're increasing it. The offset goes as a credit to service revenue, which is an income statement account. This table diagrams the distinctive timing of prepaids and accruals. With prepaids, the cash comes first, then an adjusting entry is needed to update the accounts. Accruals start with an adjusting entry, then the cash transaction comes later. Two purposes of the adjusting entry process are to measure income and to update the balance sheet. Therefore, every adjusting entry affects at least one revenue or expense to measure income and one asset or liability to update the balance sheet. Each category of adjustment has its own pattern. Notice that each involves a balance sheet account and an income statement account. And we talked about each of these examples earlier. So if this isn't clear still, you might go back and replay those slides where we talked through how to record these transactions. So after the adjustments are journalized and posted, a useful step in preparing the financial statements is to list the accounts along with their adjusted balances on an adjusted trial balance. This document lists all the accounts and their final balances in a single place. And so next we want to talk about how to construct the financial statements. The financial statements can be prepared from the adjusted trial balance. The income statement lists the revenue and expense accounts. The statement of retained earnings shows the changes in retained earnings. The balance sheet reports assets, liabilities, and stockholders' equity. And so then we ask ourselves, well, why is the income statement prepared first and the balance sheet last? And that's because the income statement reports net income or loss, the results of revenue minus expenses. Revenue and expenses affect stockholders' equity, so net income must be determined first because it is then transferred to retained earnings. The statement of retained earnings shows the computation of the ending balance of the account. Retained earnings is the final balancing element of the balance sheet. And we talked about these relationships in Chapter 1. So if this isn't clear, it might be worth going back to that chapter and just sort of refreshing your memory of that discussion. And so finally, after we've gone through all of this, we're ready to close. And by closing the books, what we mean is to prepare the accounts for the next period's transaction. The closing entries set the revenue, expense, and dividend balances back to zero at the end of the period, which is usually the year. The idea is the same as setting the scorecard back to zero after a game. Now, recognize that we're setting the revenue, expense, and dividends to zero. We are not setting the balance sheet accounts, that is the assets, liabilities, and shareholders' equity accounts, to zero. Those are cumulative balances that just simply roll forward as based on having an opening balance of some amount and then the net impact of the debits and credits hitting those accounts each period. Because revenues and expenses relate to a limited period, they are also called temporary accounts. The dividend accounts is also called temporary. The closing process applies only to temporary accounts. Permanent accounts, which we said were balance sheet accounts, assets, liabilities, and stockholders' equity. These permanent accounts are not closed at the end of the period because they carry over to the next period. Consider cash, receivables, equipment, accounts payable, common stock, and retained earnings. Their ending balances at the end of one period become the beginning balances of the next period. Closing entries transfer the revenue, expense, and dividends balances to retained earnings. Here are the steps to close the books of a company. Debit each revenue account for the amount of its credit balance. Credit retained earnings for the sum of the revenues. Now the sum of the revenues is in retained earnings. Credit each expense account for the amount of its debit balance. Debit retained earnings for the sum of the expenses. The sum of the expenses is now in retained earnings. Credit the dividends account for the amount of its debit balance. Debit retained earnings. This entry places the dividends amount in the debit side of the retained earnings. Remember, dividends are not expenses. They never affect net income. On the balance sheet, assets and liabilities are classified as current or long-term to indicate their relative liquidity. Liquidity measures how quickly an item can be converted to cash. Cash, obviously, is the most liquid asset. Accounts receivable is relatively liquid because cash collections usually follow quickly. Inventory is less liquid than accounts receivable because the company must first sell the goods. Equipment and buildings are even less liquid because these assets are held for use and are not for sale. When we invest in plant assets, we generally understand they are long-term investments. So a balance sheet lists assets and liability in order of relative liquidity. So current assets are the most liquid assets. They will be converted to cash, sold, or consumed during the next 12 months or within the business normal operating cycle of longer than a year. The operating cycle is the time span during which cash is paid for goods and services, and these goods and services are sold to bring in cash. For most businesses, this operating cycle is a few months. Cash, short-term investments, accounts receivable, merchandise inventory, prepaid expenses are the current assets. And we talked about what makes up these account balances before and the types of transactions that are reflected in the recording of the account balances. Long-term assets are all assets not classified as current assets. One category of long-term assets is plant assets, often labeled property, plant, and equipment, or fixed assets. Land, building, furniture, and fixtures and equipment are plant assets. Long-term investments, intangible assets, and other assets, which we've said before is a catch-all category for assets that are not classified more precisely, are also long-term. Current liabilities that must be paid within 1 year or within the entity's operating cycle if longer than a year. Accounts payable, notes payable due within 1 year, salary payable, unearned revenue, interest payable, and income tax payable are current liabilities. Bankers and other lenders are interested in the due dates of an entity's liabilities. The sooner an entity or a liability must be paid, the more pressure it creates. Therefore, the balance sheet lists liability in the order in which they must be paid. All liabilities that are not current are classified as long-term liabilities. Many notes payables are long-term. Some notes payables are paid in installments, with the first installment due within 1 year, the second installment due within the second year, and so on. The first installment is a current liability because it's due within one operating cycle or 12 months, and the remainder are classified as long-term. A classified balance sheet separates current assets from long-term assets and current liabilities from long-term liabilities. And we also see these reflected as current assets and non-current assets, or current liabilities and non-current liabilities. So you may see long-term and non-current used interchangeably. So then we want to talk about balance sheet formats. The report format lists the assets at the top, followed by the liabilities and stockholders' equity below. The report format is more popular with approximately 60% of large companies using it. The account format lists assets on the left side and liabilities and stockholders' equity on the right side in the same way that the T accounts appear, with assets or debits on the left and liabilities and equity or credits on the right. So this is just a preference that companies will display in how they like seeing their financial information reported. There's not one is not better than the other. It's just a matter of preference. Now we talk income statement formats. So a single-step income statement lists all the revenues together under a heading such as revenue or revenues and gains. The expenses are listed together in a single category titled expenses or expenses and losses. There's only one step, the subtraction of expenses and losses from the sum of revenues and gains in arriving at net income. A multi-step income statement reports a number of subtotals to highlight important relationships between revenues and expenses. These include gross profit, income from operations, income from tax, and net income. And again, this is a matter of preference. Generally, what I see in the industry is the multi-step format because people are interested in certain measures that we'll get into later, but they're not simply interested in net income. They're interested in certain measures between revenues and net income that they can use to compare to prior years, to look at trends, to predict some potential future behaviors and outcomes. And so the multi-step I generally tend to see used more often, but a lot of it also depends on who your target audience is. You should get the same answer regardless of which step you use. You're going to get to net income. So now we want to talk about analyzing and evaluating a company's debt paying ability. So a bank considering lending money must predict whether the borrower can repay the loan. If the borrower already has a lot of debt, the probability of repayment may be low. If the borrower owes a little, the loan may go through. To analyze a company's financial position, decision makers use data and ratios computed from various items in the financial statements. And so we want to talk a little bit about, in this section, how these companies analyze and evaluate a company's debt paying ability by using these ratios from the financial statements. When we talk about net working capital, we are just simply talking about the difference between current assets and current liabilities. So we know that we're going to have to pay our bills, and we know that our bills will be coming due within the next 12 months, and we know that what we're going to pay those bills with are current assets. We have multiple different types of current assets, which we assume are going to convert to cash that we will use to pay these current liabilities. And so this net working capital gives us an indication of how much more in current assets, which will convert to cash, do we have than current liabilities, which will use that cash up. Another means of expressing operating liquidity through a relationship between current assets and current liabilities is the current ratio, which just simply divides total current assets by total current liabilities. The current ratio measures the company's ability to pay current liabilities with current assets. A company prefers a high current ratio, which means that the business has plenty of current assets to pay current liabilities. An increasing current ratio from period to period indicates improvement in financial position. As a rule of thumb, a strong current ratio is 1.5, which indicates that the company has $1.50 in current assets for every $1 in current liabilities. A company with a current ratio of 1.5 would probably have little trouble paying its current liabilities. Most successful companies operate with current ratios between 1.2 and 1.5. A current ratio of less than 1.0 is considered quite low. The only thing I would caveat all of this with is that the goodness or badness of ratios, regardless of what ratio it is, really comes about by comparing it to the same ratio for similarly sized companies in similar industries. So we have to be careful by saying that because a ratio is high, it's good, because it could be that for similarly sized companies in the same industry, the average of those ratios is much higher. So ours may seem high, but not be as high as others in our same industry along our same size, which may cause us to have to investigate that more. So we can't just say that because it's high or low, it's good. We've got to always be comparing it to something that's comparable. Still, another measure of debt paying ability is the debt ratio, which is the ratio of total liabilities to total assets. The debt ratio indicates the proportion of a company's assets that is financed with debt. This ratio measures a business's ability to pay both current and long-term debts, or total liabilities. A low debt ratio is safer than a high debt ratio. Why? Well, because a company with few liabilities has low required debt payments. This company is unlikely to get into financial difficulty. By contrast, a company with a high debt ratio may have trouble paying its liabilities, especially when sales are low and cash is scarce. And this gets into this idea of financial leverage that we'll talk about some when we're in a financial analysis mode of discussion. Companies are keenly aware of how transaction affects their ratios. Lending agreements often require that a company's current ratio not fall below a certain level. Another loan requirement is the company's debt ratio may not rise above a certain level. When a company fails to meet one of these conditions, it's said to be default on its lending agreements. The penalty can be severe. The lender may require immediate payment of the loan. There may be also other monetary penalties involved to get the lender more comfortable that with the borrower and that a default is not going to occur. To help keep debt ratios within normal limits, companies might adopt one or more of the strategies shown. And so this ends our chapter 3. We talked a lot about various topics in this chapter, and so again I encourage you to read the chapter closely after you've read the chapter, and soon after you've read the chapter, please go into the practical module and complete the learning exercise and submit that. And if, as you continue, as we're moving through the course, if you see concepts that aren't familiar or that aren't clicking for you, don't hesitate to go back and look in previous chapters for more clarification, and don't hesitate to contact your instructor to seek clarification. And I'm looking forward to talking with you about chapter 4, and in which we will talk about internal control and cash. Thank you.